So for number 5, determine the depreciation expense for the second year of equipment costing $28,000, salvage value $4,000, and a 4-year useful life using the straight line method. Now this is, assuming that they place this asset at the beginning of the year, this is a trick question if you think about it. I'm asking for the straight line depreciation expense for the second year. Wouldn't it be the same for the first year? Again, under the straight line method, it's going to be the exact same thing, the same each year. So for this one, there's two different ways, two different approaches to answer this. There's the long way, depreciable base, times the straight line rate, and then there's the other way, cost minus salvage value divided by estimated life. But it's actually the same equation if you think about it. If you add these two equations, it's the same thing as this equation. What is your depreciable base? The difference between your cost and your salvage value. That's this number, cost minus salvage value. So I have the depreciable base in this formula too. What is your straight line rate? This one I'm going to write it down. 1 divided by 4. So 1 divided by the estimated useful life. It's the exact same equation as this. Some people prefer to do it the long way. Some people prefer to do it this way. I'm going to do it both ways. Depreciable base. So the cost is $28,000. Salvage value is $4,000. What's my depreciable base? $24,000, right? So 24,000 times 1 over 4 equals 6,000, right? We'll do the exact same thing here. 28,000 minus 4,000 divided by 4, what does that equal? 6,000. So again, it doesn't matter which method you choose to use, you'll get the same answer. But for this one, the straight line rate, you do need to understand what the straight line rate is, because that actually is relevant for the next problem. For the next problem, number 6, using the facts from number 4, wait, I meant to say number 5. That was a typo. Using the same facts from number 5, determine the depreciation expense for the second year using double declining balance method. So this involves creating a table, and you got to keep track of the ending, actually the beginning net book value. So again, depreciable base is the difference between cost and salvage value. Net book value is the difference between the cost and accumulated depreciation. Accumulated depreciation, that's the sum of the depreciation that you've claimed since inception of the fixed assets, since you put it in operations. So this is how I would do the table for this one. Again, this one is just a partial table since we're only doing it for 2 years. So this is how I would set it up. The beginning net book value, well, the first column, year. So I'm going to do year 1, 2, 3, 4, and so on, depending on the number of years. Next, I'm going to put the column for beginning net book value. By the way, the beginning net book value is last year's ending net book value. Next column I'm going to put is depreciation expense. I'm going to put a column for accumulated, and I'm going to abbreviate depreciation. So again, so far we have a column for year, each year, beginning net book value, depreciation expense, accumulated depreciation, and I'm missing a column. The ending net book value. So again, book value, net book value is the cost minus accumulated depreciation. At the beginning of year 1, what is the net book value? It's the cost, right? There is no accumulated depreciation. So the net book value is the cost, 28,000. Again, we use 28,000 here as the cost. We're using the same facts. So 28,000. How do we do the depreciation expense? It's going to be the beginning. By the way, in case you don't remember, the depreciation expense under the double declining method is actually very similar to this. And I'm going to do it over here. Double declining balance. The equation is net book or beginning net book value times double declining balance rate. So remember that. That's the equation we're going to be using in this column. The double declining balance rate is double the straight line rate. So the straight line rate is 1 over 4. So 1 over 4, I got 25%, a quarter, right? So what would be double that for this problem? 50%, right? So if the straight line rate for this problem is 25%, I'm taking 25% of the depreciable base as a depreciation expense each year. That's the straight line rate. On the double declining balance, we're taking double that rate, but double of the net carrying value, or the beginning balance. So it's 28,000 times 50% equals 14,000, right? Depreciation expense for the first year, 14,000. What's the accumulated depreciation for the second year? What's the accumulated depreciation for the first year? 14,000, right? That makes sense, right? We have the ending net book value, which is always going to be the cost minus accumulated depreciation. So the cost is 28,000 minus 14,000. What do we have? I don't have a calculator, but I'm thinking it's 14,000, right? Again, that's last year's ending net book value. I'm going to use this for the second year. 14,000, right? So we got 14,000. Again, we're using this exact same equation again. The beginning net book value times the double declining rate. So that's my beginning balance of net book value times 50% equals, somebody with a calculator.
7,000.
Very good, 7,000. And that equals, accumulated depreciation is now 21,000. So we claimed $14,000 of accumulated depreciation, of a depreciation expense the first year, 7,000 the second year. So the sum of that is 21,000. The ending net book value would be cost minus accumulated depreciation. So 28,000 minus 21,000 equals 7,000.
Professor, the 50% is based on the 1/4 from the rate on this side, right?
Correct.
This is 25%.
Right. For the straight line
Because it's
depreciation method, it's 1 divided by 4. That's 25%. We're taking 25% of the depreciable base each year. That's straight line. Double declining balance is double 25%, which is 15%. But it's computed 50% of the beginning balance of this number. So we're going to have to do this table for double declining balance.